Here's something that quietly surprises a lot of retirees. Some people retire with around $1 million from day one. They assume that number one is one steadily path downward. They expect retirement to be about managing decline. How long will the money last? How careful do I need to be? How much risk can I really afford anymore? That assumption shapes almost every decision they make. It influences how much they spend, how much they react to market swings, and how confident or anxious they feel about retirement as a whole. But then something unexpected happens. 10 or 15 years into retirement, they check their accounts and realize they're actually worth more than when they stopped working, sometimes significantly more. Not because they stopped enjoying life, not because they chased aggressive investments, and not because they timed the market perfectly. It happened because retirement doesn't work the way most people think it does. Once income, spending, taxes, and risk are coordinated properly, retirement often becomes more stable over time, not less. And if you don't understand this shift, it's easy to underestimate what your plan can truly support and to live more cautiously than necessary. Hi, I'm Mark Aarons, President of Money Managers, Inc. If you're new here, feel free to like the video, subscribe, and leave a comment. It helps me more people to find clear, practical retirement guidance like this. Today, I want to walk you through a continuative outcome we see more often than people expect. Why retirees who start with $1 million often end up with 3, 4, or 5 million later in retirement, while still spending, traveling, and enjoying their lives. We'll talk about how retirement spending actually works, why income changes the pressure on your portfolio, how risk behaves over time, and where planning, not market prediction, makes the biggest difference. Let's walk through this together. Why most people misunderstand retirement money. Most people imagine retirement as a straight downward slope. You accumulate assets, you retire, then your portfolio slowly declines until it reaches zero. That mental model creates anxiety. It leads people to underspend, it causes overreaction during normal market volatility, and it often pushes retirees into overly conservative decisions that don't actually improve outcomes. The reality is that retirement is not a single phase. It's a series of financial seasons, each with different priorities and risks. Early retirement looks very different from mid-retirement, and late retirement looks different again. When those seasons are planned intentionally, portfolios don't behave like melting ice cubes. In many cases, they flatten, stabilize, and later begin to grow again. Now, part 2 is that spending is heaviest early, and that's normal. One of the most overlooked dynamics in retirement is how spending changes over time. Spending is rarely consistent year after year. In the early years, spending is often higher. Travel and experiences, dining out and entertainment, hobbies and lifestyles, upgrades, helping children or grandchildren, doing the things work once limited. This is often the healthiest, most active phase of retirement, and it's intentional. But over time, spending naturally shifts. Travel becomes less frequent, large discretionary purchases taper off, daily routines simplify. This doesn't mean retirees enjoy life less. It means priorities change. And when spending declines while income remains steady, the math quietly improves in the retiree's favor. Now, part 3, why income sources change the entire equation. Early in retirement, portfolios often do most of the heavy lifting. Later on, the burden shifts. As retirees age, they typically layer in reliable income sources such as Social Security, pensions, and other structured income strategies. Once these sources cover a meaningful portion of the core expenses, housing, food, insurance, utilities, the role of the portfolio changes. Instead of acting as the main paycheck, the portfolio becomes a secondary support system. This often leads to smaller withdrawals than originally planned, periods with no withdrawals at all, greater flexibility during market volatility. That shift is subtle, but it dramatically improves long-term outcomes. That performance sequence risk is real, but it doesn't last forever. Sequence of returns risk matters, especially early in retirement. Poor market returns combined with withdrawals can permanently impair a plan. But what often gets missed is this. Sequence risk is front-loaded. Once retirees move beyond those early vulnerable years, withdrawals typically decline. Income sources carry more weight. Cash reserves grow. Portfolio volatility matters less. Later in retirement, markets don't threaten the plan. plan the way they once did. In many cases, markets begin working for retirees again. That's why many retirees are surprised by how their net worth looks years after retirement. Now, part 5 is tax strategy is a quiet multiplier. Taxes rarely show up as one large, obvious expense. Instead, they quietly erode wealth year after year. Retirees who plan thoughtfully often coordinate withdrawals across account types, smooth income across tax brackets, reduce forced distributions later in life, avoid unnecessary tax spikes. Each decision may feel small, but over 20 or 30 years, the difference can be substantial. Keeping more of what you already earn compounds just as effectively as higher returns, and often with less risk. At part 6, we have many retirees simply don't spend what they expected. Another reality most people don't anticipate. Many retirees don't actually spend as much as they thought they would. Not because they're afraid, not because they feel restricted, but because major obligations are already behind them. Lifestyle upgrades are complete. Saving is no longer necessary. Additional spending adds little incremental value. At a certain point, spending more doesn't meaningfully improve quality of life. So excess income stays invested. That unused capacity becomes growth capital, often unintentionally. Now, compounding continues in retirement. Retirement doesn't end compounding. It simply changes its role. When withdrawals slow and portfolios stabilize, compounding resumes quietly in the background. Even modest growth rates applied consistently over decades can produce surprising results, especially when withdrawals are lower than expected. This is why retirees are often surprised by their net worth in their 70s and 80s. Now, part 8, how $1 million can turn into $5 million. When you put all this together, the outcome makes sense. You have front-loaded spending that naturally tapers, income sources that reduce portfolio pressure, lower withdrawals over time, reduced tax drag, long-term compounding. The portfolio doesn't just survive, it stabilizes. Then it regains momentum, then it grows. That's how $1 million starting point can quietly turn into 3, 4, or even 5 million over the course of retirement. Not overnight, not automatically, and not without structure. Part 9 is why this doesn't happen for everyone. This outcome is possible, but it isn't guaranteed. It depends on how income is structured, how withdrawals are coordinated, how risk is managed, how taxes are handled. Without a clear plan, retirees may withdraw too much too early, react emotionally to markets, trigger avoidable taxes, lock themselves into rigid decisions. This is where planning makes a real difference. Here's the big takeaway. The biggest mistake many retirees make isn't spending too much. It's assuming their money is fragile. In reality, when retirement income is structured properly, when spending aligns with how life actually unfolds, and when taxes and risk are managed intentionally, retirement wealth can be far more resilient than people expected. That's why some retirees are surprised in a good way by how their net worth looks later in life. Not because they chased returns, but because they planned to allow money to work differently once work stopped. If you're approaching retirement or already retired and want clarity around how your plan is structured, you can schedule a conversation. Use the link below. If you found this helpful, feel free to like the video, subscribe for more clear, practical retirement guidance. Thanks for watching. I'll see you in the next video.